Recently, Minority Mindset, a financial education channel on YouTube, made a video about making $1,000 a month from dividends. And we want to tell Jaspreet, the host, not so fast. If you want to have our view of the whole issue, watch this video till the end. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. And if you are doing as great as I am, you know what? Go get a cup of coffee or tea or vodka and let's roll. Today I want to have a conversation around dividend reinvestment plans. I want to have a conversation around making money from dividends alone, having some kind of a fixed income coming every month or every quarter, every year. And the premise of our conversation is from one of our favorite channels, Minority Mindset. It's a great channel. We love the host. We watched a lot of videos from Jaspreet, and he released a video recently about making $1,000 a month from dividends. And we kind of think that it's not that easy, it's not that straightforward, and we wanted to add our 2 cents to the whole debate. So just kind of lay the foundation of the conversation here. Jaspreet, the host of Minority Mindset, gave the example of McDonald's, and he was actually talking about, he literally talked about using DRIP, dividend reinvestment plan, and compounding to arrive at the amount of $1,000 every month, but that will happen over 10 years according to his calculation. Now, Jaspreet said that you need 3 things to get to 1K a month. You need financial education, you need consistency, and you need compounding. And that's definitely true. I definitely agree with that. One thing that I want to add that Jaspreet probably didn't remember is that you need to have also mentoring. You got to have a support system. So financial education is kind of cool. Consistency is cool. Compounding is cool. But you control financial education and consistency. You cannot control compounding. You got to have another factor that you can control. That's mentoring or coaching. There are a lot of ways to get that. You can get into a nonprofit investment club, stock investment club. We have gazillions of them throughout the country. Or you can just beef up your own education on the internet. You can join Facebook groups, Twitter groups, LinkedIn groups about investment. So although we agree with Jaspreet in theory, things don't happen so fast in practice. And here is why. To reinvest dividends, you can either do it yourself or set up a DRIP. A DRIP, as I said earlier, is a dividend reinvestment plan. Now, the latter is better. The DRIP scheme is better because then you sort of automate everything, or you outsource the reinvestment part of things to another company or another entity. But sometimes it could be complicated depending on the DRIP administrator. So you need to have a clear plan for stock investment. This is another reason why what Jaspreet said for us, it's a little bit of a shortcut. Again, we love Jaspreet. We think he's brilliant. We have subscribed. We have watched tens of videos. But on this particular issue of dividend reinvestment, we wanted to add our 2 cents. So you got to have a clear plan for stock reinvestment, which is why it's not that easy to get to 1K in dividend income a month. You need to account for opportunity cost. There's something called opportunity cost. What is it? You need to think about whether there are other stocks out there better than McDonald's, because he used the McDonald's example in his video. You got to think about during the 10-year period that you are actually having your money stuck in the McDonald's equity. What if there are other stocks out there? There are way better in terms of yield, in terms of dividend yields, in terms of capital gain appreciation potential. Another reason why it's not really that easy to make those things happen in practice is that you need to factor in your portfolio's asset allocation. I'm talking about, as you age, you need some rebalancing. So using the example of McDonald's, for instance, or any other stock for that reason, I mean, for that matter, I don't want to sort of focus on only McDonald's here, but the point is, if you make the choice to be quote unquote stuck in an equity, in a share of equity for 10 years, there are some potential asset allocation implications, because as you age, you need some rebalancing. For example, if you're 20 years old, if you're in your 20s or 30s, you probably will start with what I call 60-30-10. That means 60% equity, 30% bonds and 10% cash. But as you age, when you are in your 40s or 50s or early 60s, you need to rebalance and reverse that proportion. So instead of having 60 in stock, you probably have 60 in bonds and 30% in stocks, and then you keep the cash at 10%. So is McDonald's stock really a good bet in your 50s? Those are questions I want to have a conversations around. Another reason why we agree with Jaspreet in theory, but believe that things don't happen so fast in practice, is that you need to ensure your portfolio's alpha and beta are optimized. And therefore, you may have to sell some McDonald's stock and reinvest the proceeds in other assets, again, just to be able to maintain the alpha and beta. And Jaspreet also talked about one stock, again, the McDonald's one. In other words, what we believe, the reason why this theory, the premise is a little hard to implement in practice, is that he used a mono asset hypothetical portfolio. So a portfolio with only one asset. In reality, a lot of investors, from the most sophisticated investor to the newbie on the block, they have 10 or 20 or 30 stocks in their portfolio. So if we take a real life portfolio with multiple asset classes with different betas, for example, that monthly 1K dividend income that Jaspreet was talking about may or may not be easily attainable. So there are other factors you have to think about when you are thinking about implementing a stock to give you 1K a month in terms of dividend income. I really want to spend some time on the DRIP thing because it is very important. DRIP, dividend reinvestment plan, it is important because this constitutes the cornerstone of Jaspreet, the minority mindset host. This constitutes his argument. In other words, you have to reinvest, you have to automate the reinvestment of the stock. So let's take a few moments to understand really what those DRIPs are. So as an investor in dividend paying stock, it is important that you leverage the tools available to you in order to maximize your return on investment. And there are many financial ratios. I mean, we know we have the dividend yield, the yield on cost, and the payout ratio that are used by investors to make educated investment decisions. There is also another kind of tool that can help income investors lower their cost and build a solid portfolio over time, aka DRIP investing. Now, you got to set up a dividend reinvestment plan so that you are slowly growing your money. The DRIP, just so you know, sometimes people call it DRP, and it helps you limit your expenses, the expenses that you're paying to a broker, while reinvesting all dividends back into the same stock. Let me take a closer look at what a DRIP is and how it can help you, the average investor. So Investopedia did a piece recently about a DRIP, and they said that a DRIP is a plan offered by a corporation that allows investors to reinvest their cash dividends by purchasing additional shares or fractional shares on the dividends payments date. For most dividend investors, guess what? It's a great way. If you setting up a DRIP is a great way to maximize the value of their investment with no action required. Depending upon the stock and the brokerage firm, most dividend reinvestment plans allow the investor to purchase shares with no commission or fees. If you have a broker who wants to charge you who wants to charge you fees for the DRIP, please leave a comment below, and we will certainly direct you to. There are a lot of brokers out there who don't charge. They don't charge fees for setting up a DRIP. So, and it's important because if you can avoid fees, this can drastically cut down on expenses that are often required to build and maintain a profitable portfolio of dividend stocks. Let's talk about the types of dividend reinvestment plans. So there are a couple of different types depending upon the brokerage that you currently do business with, or the country where you're located. So we're gonna focus on two. So you have one that allows the investor to purchase stock directly through the company. So if you own, let's say Tesla stock, you can purchase the stock directly through the company. And the other one requires a third party to invest. Let's talk about the two let's spend some time to analyze the two. So you have company managed. So there are several companies that actually run their own drips. So these companies usually allow the investor to buy shares of their company directly through them without a broker. So they also allow investors to buy partial shares, which can be a great way to invest if you don't have a lot of capital to start with. So companies from McDonald's to Procter & Gamble, P&G to Walmart, they are basically offer that service. And then you can buy it through the company, or you can buy it through the broker, so that your brokerage account. So most online discount brokerages, such as Robinhood or M1 Finance, they allow their customers to reinvest their earned dividend back into the stock at no cost. Though the incentive for the broker is to keep its current clients by offering this feature, while the investor gets a discount on the expenses they will have to pay. So setting up a drip through your online broker usually takes just a few minutes. It doesn't take 24 hours. You just have to go on your account dashboard, and you got to go to settings, and then I'm sure there is a button out there. If not, just give them a call, give your broker a call, and they'll certainly walk you through it. So what are the advantages of drip investing? It's kind of important to sort of look at the if you want to be a successful investor, dividend investor, you can use drips on at least a few stocks in your portfolio. You don't have to use them on all of them. You got to see which one is appropriate for you. And let me give you a few perks. So you can purchase fractional shares. So if an investor, for example, receives, say, $20 from a dividend payment and the share price of the stock is $40, a drip makes it possible to purchase 0.5 shares. So one half. So this allows investors to continue to build their position by reinvesting all of their dividend payments immediately back into the stock without having to wait to buy a full share. So besides fractional shares, you also have automated stock purchase. So these types of plans can be set up to automatically reinvest any dividend payments directly back into the stock. So there is no action required by the investor, which makes it a nice option for those of us who have hectic lives. So it generally takes less than 5 minutes to set up this feature with an online broker. And the third advantage of drip investing is that you have no commission. Think about it. This is fantastic, right? So a great thing about drip is that they generally don't require any commission be paid. So most online brokers don't charge any commission fees when an investor decides to reinvest their dividends back into shares of the stock. So this is great for the investor because this can lower the overall cost, and the broker who gets to hang on to a customer longer by offering this feature. Again, if you have a broker who wants to charge you for it, let us know in the comment. We will direct you to some of the top brokers out there who do not charge for this kind of service. So I've talked about the pros of drip investing. Let's talk about the cons. What are the cons? Are there any cons? Of course, there's no free lunch, right? So you have pros, you're going to have cons. Let's talk about the disadvantages here. So diversification. So setting up a drip for the long term can prevent you from having a diversified portfolio. It is essential that you monitor stocks in your portfolio to ensure that any dividends should automatically be reinvested. So because of that, you're kind of stuck with the stock. Think about it. You're stuck with the stock. So if you, going back to the earlier example that Jaspreet took in his video, you are stuck with McDonald's for 10 years or 15 years. And if something's going on with McDonald's, if the company is no longer performing, you're still stuck with them. So diversification is not really king. It's not really a biggie when you choose a drip. You also have another disadvantage is that initiating new positions. So many investors use the income they generate from dividends to initiate a new position in their portfolio. So using a drip prevents this from happening, as all the income is reinvested back into the same stocks, leaving no money to open positions in new stocks. So if you see a mid cap, a small cap, very promising stock out there that you're interested in, you're going to have to put in more cash from your own pocket, not use the cash from your portfolio. And tax tracking can be a hassle when it comes to drip. So you need to keep excellent records of your transactions if you invest with drips outside of a tax advantage retirement account like a Roth IRA. So making multiple stock purchases each year can give you a very different cost basis for each lot of stocks you own. So you can alleviate this hassle by investing in an IRA or another tax advantage account by using an online brokerage account, an online discount brokerage, right, that offers tax management software, or by keeping excellent records yourself. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. We're having a conversation today about dividend income. And the conversation was started, the premise of today's show was a video that Jaspreet, the awesome host of Minority Set, one of our favorite financial channels, he posted a video about making $1,000 a month from dividends. And he made a few, I would say, he made a few arguments. He took a few positions in that video. And then we thought that to sort of complete the whole conversation, we wanted to offer our side of the story and say that it's not that easy to get $1,000 a month from dividend income, even if you have a large portfolio. I mean, we're talking, if you have a large portfolio like $500,000 or $1 million, it is possible. But I think most of Jaspreet's viewership is not made up of those individuals. So we want to set the record straight and explain how things work in reality and say that things in practice don't work that easily. So I've talked to you about DRIPs, what they are and how they can help you. And now I want to talk about certain things that is very important. Important dividend investing calculations that you need to consider. Because if you want to be a dividend investor, you got to know how those things are calculated. So in general, dividend investing is not very complex. In fact, the simpler you keep it, the better you'll do. So good investing is kind of boring. However, there are several dividend investing calculations that you should consider as you build and monitor your portfolio, whether you want to put McDonald's or Tesla or Dell or Microsoft or Facebook in your portfolio. It doesn't matter, but you got to have some considerations in terms of dividend calculation. Here are 3 key dividend investing calculations that you need to know. Number 1, you have the annual dividend yield. This is actually the calculation of the percentage of dividend per share received relative to the stock price. So this is a great parameter and barometer of the annual income you receive from investing in a stock. For example, if you invest in a $50 stock and it pays, say, $2 per share in dividends, this equals a 4% annual dividend yield. If it pays $5, this is equal to a 10% annual dividend yield. Some companies call it annual distribution. They don't call it dividend, they call it distribution. So if you plan on living off dividends, you want the annual dividend yield based on the cost you invest in the shares to be as high as possible. And that makes sense. So besides annual dividend yield, ADY, you got to think about the DGR, the dividend growth rate. So this is kind of important. It is quintessential, folks. Personally, I think that I love investing in stocks that continually increase the dividend because you basically are getting a raise, right? You get a raise every quarter or every year for doing absolutely nothing. This is the epitome, if you will, of passive income. You're just chilling, sleeping, taking care of business, taking care of your family, traveling, and money is rolling into your account. So you can calculate the dividend growth rate on any annual time frame. To do this, you want to take the current year's dividend per share divided by last year and subtract 1. So this will essentially calculate the dividend growth rate compared to the prior year. And the third metric that's kind of important also is the dividend payout ratio. So this measures how much a dividend stock pays in dividend relative to its earnings. So you must consider the payout ratio of a stock because a high payout ratio means the company is retaining limited cash to be reinvested in the business. You want the company to strike a nice operational balance, right? You want them to be able to give you cash a little bit as a shareholder to pay some dividends, but also to reinvest money in the business. Now, if they're giving you too much cash, what's happening is that they're not reinvesting in the business, or even worse, the management has not identified any profitable opportunity to seize, which is, if you think about it, it's a harbinger of future trouble. So this is something you have to think about. Of course, you want stocks that no matter what will maintain its dividends or increase it over time. All right. If you want to live on dividends, you must focus on the income component first. So make sure that the dividend will never decrease in value. You need two things. You need stability of the income and stock appreciation. So good stocks increase their dividends over time and the stock value appreciates as well. This is since the earnings are likely increasing as well. I also want to talk about, so I've talked to you about DRIP, and I've talked to you about the fact that it's not that straightforward to make $1,000 a month from dividend. And I've spoken to you about the 3 metrics you have to pay attention to. Let's now talk about how to identify the best long-term stocks for dividends. So, nowadays we have myriads sources where you can find information from going on the internet, going on websites such as Yahoo Finance, Market Watch, Wall Street Journal, Bloomberg, CNBC, and so on and so forth. You can go from there to reading a book about financial education. You can join an investment club yourself in your area. You can go online on social media groups about that. So one thing you have to do is you have to pay attention to certain things in terms of what you're looking for. So before we even talk about identifying the best long-term stocks for dividends rather, you need to think about what your goals are. What is your financial goal? What is your main financial goal? But once you have that, then you can actually think about a few things. First, is the company shareholder friendly? So has the company increased its dividends in the last 3 to 5 years? Yes or no, right? So this is basically a small checklist for yourself to know how to identify the best long-term stocks for dividends. The second thing is you want to think about the financial stability of the company, the financial health. Does the company have a modest dividend payout ratio? Modest ratio in my view will be 1%. So this is what I call a modest dividend payout ratio. So you got to ask yourself, yes or no, is the company stable? What about the management team? Was the current CEO hired internally? Yes or no? In terms of operational excellence, so do they have a track record of revenue and earnings growth? Has the company provided a long-term growth plan? So this is the kind of stuff that takes a little bit of time. You have to go and read, but believe me, that reading you're going to do, that's great reading. And you can read the quarterly filings with the SEC or the annual filing with the SEC, or even what you can, if you get some time, which I do all the time, you can listen in on the investor presentations, because you want to hear the CEO speak by himself or herself. Not anything written. It's not something written by a PR firm that the company has hired. No, you want to hear the leadership talk, and that gives you a different sense of what's really going on internally. So you also want to think about the business model. So do you understand the business model of the company? A lot of investors, especially retail investors out there, they just buy the stock based on the buzz, the media buzz, but they do not understand the business model of the company. I'll give you one very simple example. You who are listening to me right now, do you understand the business model of Amazon? I guarantee you, 95% of folks do not understand the business model of Amazon. People are thinking Amazon is an online platform, but no. Amazon is way more than that. It's way more than that. When you dig deeper, you realize that Amazon is an infrastructure company. So right there, I just showed you that a lot of people buy companies without understanding the business model of the company. So for you to identify the best long-term stocks for dividends, you need to understand the business model. And you also have to think about, is there a significant moat around the company? Yes or no? So I give you five criteria that you have to go through to identify great stocks, especially for dividends. So shareholder friendliness, financial health, management team, operational excellence, and the business model. I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? Hope you are doing fantastic. I'm doing marvelous, and we're actually having a conversation about the great idea that Jaspreet from Minority Mindset initiated about the fact that you can get $1,000 a month from dividends, and you know, we love Jaspreet here at the Sweetie Kiwi Show. We believe he is a brilliant dude, and the premise of the conversation he had in his video is kind of cool. But we kind of felt like it was a little incomplete, so we wanted to add our 2 cents to the debate. So let me give you a couple of steps you can use to invest for passive income with the goal of living off of dividends. So basically, I told you how you can identify dividend growth companies. Now I'm going to give you a few steps, very basic steps that you can use. And you first want to have I would say a process in place whereby you contribute a little bit of money every month to your dividend portfolio for the first year. So you can set, like, you can have maybe $100 every month that goes to your dividend growth portfolio, and try to make this automatic. You want to make this automatic because you don't want to, and you want to pay you want to make that every month so that the debit goes out even before all the other expenses are paid. And what you're trying to do is that you're trying to basically get into the habit of having some liquidity. And if the liquidity is there, then you can start buying stocks with that cash. Now, $100 is a minimum. I personally believe you can increase it. If you can increase it, even better. So once you do this, and you do this for 1 year, the next year you contribute $125. So you increase your monthly contribution by 25% per year. This might sound like a lot, but honestly, if you are able to increase your income and you're able to increase your contributions rather, you would see a fantastic change in the growth of your portfolio. In other words, you will have enough money to buy more stocks. You'll have enough money to even sit and wait for the best opportunity. That's what Warren Buffett does. He's not sitting around and just running around and just chasing stocks. No, he's just sitting. He's just sitting, relaxing, and waiting for the right opportunity. That's what cash allows you to do. So you're sitting around and you're looking for the best opportunity. You're not actually chasing every chicken that comes out of the farm. No, you are waiting for that goose, that nice goose for you to jump in. This is not a good metaphor, but I think you get the point. So my point here is that first year you contribute $200 per month, $100, $200, whatever you can contribute. Second year, you want to increase your contributions, 25%, 30%, whatever you can. And the third thing you want to do, the third step here, is that any dividend income you receive should be reinvested into your dividend growth portfolio. So once you receive dividend income, use this to buy more stock in your portfolio. So rather than a dividend reinvestment plan, you can invest at your own discretion. So a dividend reinvestment plan will automatically buy shares in that specific stock, but without the drip. You can invest in a stock when it declines in value, or you can invest in a different dividend stock in your portfolio. That's kind of cool. So you have that freedom. And the fourth step is try to invest in quality stocks. I'm talking about those stocks that enable you to achieve 6, 8 to 10% growth rate in your equity value, not just the dividend here. No, here we're talking about the capital. So capital appreciation. So you want to have a capital appreciation of 6, 8, or 10%. And again, this shouldn't be hard to do as long as you are able to identify the right dividend, the right stocks, and most important, wait. You got to be patient and do your research, and you got to be patient. And the thing, and the fifth steps here is that you have to constantly allocate cash based on your asset allocation. In other words, asset allocation means what? It means that you decide how much of your cash you want to put into stocks, for example, and how much you want to put in bonds, in cash or real estate or other assets out there. And you want to rebalance your portfolio every quarter, every 6 months, or every year, depending upon what kind of asset allocation mix you have in place, so that you're able to get to an optimal portfolio with a great beta and a great alpha. And that's the goal. Whether you have a dividend stock portfolio or a regular portfolio, you have to chase alpha and beta and make sure that you want to optimize those two metrics as much as possible. All right, before I close, I know this was not part of the conversation, but I really want to say that there are some drawbacks to dividend investing in the first place. So dividend stocks are generally less risky than non-dividend stocks. That's for sure. Everybody knows that, hands down. But they do carry some risk and may not hold sufficient promise of rewards for some investors. So before you make a well-informed decision of dividend or whether or not dividend stocks are right for you, you want to consider not just the pros, but their cons as well. So in general, dividend-paying companies, they see less price appreciation than growth stocks. So you got to think about what's important for you. Are you interested in capital appreciation? Do you want the stock price to grow, to increase, or are you interested in income? Because dividend stocks, they generally behave, if I can use that term, they behave like fixed income securities. So preferred stocks or bonds. So they don't really move. They're kind of slow. They're kind of lethargic. So for instance, if Tesla is posting 100% ROI year over year, or Apple is doing the same thing, you might have a company like General Electric or IBM or Caterpillar being a little lethargic in terms of the price increase of its shares. So you got to think about it. That's a minus. But you have to think about if that works for you, then fine. The second disadvantage here is that share prices can drop whether the stock pays dividends or not. Companies can slash or eliminate their dividend payments at any time for any reason. So as a shareholder, you are at the end of the line when checks are cut. So it's not a contract. They haven't signed a contract with you promising to make payments every quarter or every month or every year. So they can decide that. It is discretionary. It is a discretionary decision. And the last disadvantage of dividend investing is that tax rates on dividends can rise, making dividend stocks a less attractive option for the company to pay and for you to receive. Right? So I just wanted to open a little parenthesis on that. Overall, folks, dividend reinvestment plans are great. Dividend investment is a great tactic. I just wanted to show you, or I just wanted to talk to you about some of the drawbacks out there. All right. Thank you so much for today's conversation. I really appreciate it. I want to thank Jaspreet from the bottom of my heart about this topic. It is a great topic, and he had a great video. And you guys might want to check that video. It's a Minority Mindset, the channel, and make $1,000 a month from dividends. Great guy, brilliant guy. We just wanted to add a little contribution to the debate and shed some light on an important topic, so millions of investors who are out there can understand what's really happening when it comes to dividend investing. Thank you, Jaspreet. Thank you, everybody, for listening to this conversation. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.